Hello and welcome back to yet another exciting week on the stock market. In this week's episode, I will walk you through the news. I will talk about the topic of adjusting your expectations to your portfolio. Then I will give an update on my portfolio. So let's start by looking at the news. Jerome Powell gave a speech at the Senate this week. I will of course include a link in the description below. I found the interview on New York Times. It's a 2.5 hour long video. But don't worry, I will also include the timestamp so you can go and find the speech, since the speech is only around 10 minutes long and the rest is a Q&A session. So if you only want to hear the speech, then you can go and watch that video and use the timestamps which I have included so you can save a bunch of time. I will just highlight some of the points from the speech which I think is important to note as an investor. So for instance, Jerome Powell, as much as it is possible, closed the door to negative interest rates, since he said that it is not attractive for the US economy to have negative interest rates. It was also highlighted that the Federal Reserve still sees big challenges for the US economy for a long period of time, since they will have to deal with a decline in the BNP for 2020 by 9.3% at the end of the year, which I also highlighted in a previous episode, and they expect to see a positive growth in 2021 by 5% and by 3.5% in 2022. But at the same time, the unemployment rate will still be at around 6.5 to 5.5%. It was also made clear that the Fed has not made up their mind yet regarding yield curve control. They are still in the very early discussions of whether or not this will be a tool that they will be using. So the only thing we know with certainty is the Federal Reserve is prepared to do whatever it takes for as long as it takes. So all this leads to adjusting expectations, because what should I as an investor expect and what should you as an investor expect? I will try and answer that question from my perspective and see what should I expect from my portfolio. So in my search to adjust my expectations to my portfolio, I stumbled across a book called The Little Book of Common Sense Investing by John C. Bogle, or Jack Bogle, who is known as the father of index investing. He has also founded the company, the Vanguard Group, which is famously known for doing index investing. And for those of you who want to know more about who Jack Bogle is, I will of course include a link in the description below, just like I will include a link to the Little Book of Common Sense Investing, since I think there is a lot you can learn from that book. So one of the things that I've learned from this book, when they were analyzing different investment funds, is less than 1% will beat the market by more than 2% over a period of 35 years. This means in order for me to adjust my expectations, it will be very unlikely for me to expect more than the market return. Less than 1% will receive more than the market. And since I think it's much more likely that I will be around the 99%, sure, I should just expect the market return. So one of the key learning points from this book is you should really focus on the cost of your investment, since whenever someone is gaining money at the stock market, someone must be losing money. Hence, as the market as a whole, in order for you to keep more of your investments, you should lower your costs. So by buying an index fund, which will give you the market return, then when you have to choose between different funds, in theory, you should simply just look to the one with the lowest cost, since that is the most likely to give you the highest return, at least in 99% of the cases over a 35-year period of time, which they have analyzed. And I know that this very well contradicts what I am doing, since I'm actually picking individual stocks. But you always have to second guess what you're doing and trying to see if you can learn something. Is there something you can optimize? If there's something that you have missed when you're doing your analysis. So it is much more clear to me now why there's so many people who are simply just saying you should buy ETFs and don't spend your time looking into different companies and analyzing all the data you have there, simply because you will most likely not get paid by doing that. It's better just to hold the entire market and forget about it. So hopefully I'm trying to reflect it as fairly as I possibly can, and trying to show that I am in no way stating that the way that I'm investing is superior to something else you can do. Actually, what I'm showing from this particular book is what I'm doing is most likely not superior. But nonetheless, let's take a closer look at my portfolio and see what has happened within the week. So when we take a closer look at my portfolio for this week, the first thing we notice is there was a red circle for this week's episode, so my portfolio is down in value. Well, when you look at the value here, you see that the value is more or less identical to last week. It's still $58,900. Well, I have added $250, so I think it would be fair to say that I'm actually down in value compared to last week's episode. So where did I actually invest my $250 this week? Well, I decided to invest $250 more into Pfizer, and this is again a mixture of dividends received and fresh capital. So if we go and take a closer look at the dividends tab, we can see that I have now breached the $200 mark yet again. And if you take a closer look at my portfolio out here, you can see that I have a lot of companies which are paying out every single quarter. And that means, since I had a really nice dividend back in March, I should expect to have a nice dividend again here in June. Of course, there are some companies which have slashed their dividend or cut it. So I'm actually expecting to receive an amount between the $200 and the $300 mark. And I think it will be closer to the 200, since there was unfortunately a lot of my companies which has slashed it. But nonetheless, this week was actually a remarkable result for me, since I had 4 companies paying out a dividend. So 3 of them paid me close to $50, International Paper close to $10, Realty Income Corp close to $4, and Prudential Financials close to $60. So in total I have received around $120 this week. So when I'm buying for $250 this week, the portfolio almost paid half of that. This is really going the right direction, I think. I know that this will not be the case every week, but from time to time the portfolio is really contributing a lot into buying more stocks and growing the portfolio. So one thing to note here is, eventually when you want to live off of the dividends from your portfolio, then perhaps you would like to have a steady income every single month instead of having huge spikes like I have in March compared to what I had back in February. I mean, the 2 first months doesn't really count, because when you're starting to build your portfolio, it will take time before the companies actually starts to pay out. But for instance, for the next month, since I have a lot of companies which have slashed their dividend, I would expect to receive a much lower amount next month. So over the course from now and until retirement, perhaps it would be a good idea for me to see if I can increase the number of companies which will actually pay out a dividend in July. But I mean, I have a long time to do that, so currently it's really not something that I'm concerned about. And as long as I'm receiving dividends spread out over the year, then it's not particularly important for me that I get it in this specific month or this specific month. As long as I have them within a same quarter, then I should really be fine. But you can of course have a different preference and would like to have it as a steady income every single month. So let's take a closer look at some of the news which is relevant for my portfolio. For instance, analysts sees good news for US bank dividends. So there are some different stress scenarios that the central bank can enforce on the banks and saying that they are required to have more capital to drive their business. And in the short term, the Fed is punting the most important decision, which seems to make sense given the lack of clarity ahead. That implies that dividends aren't at risk in the short term and takes the threat of a short-term regulatory shock off the table, in our view. And this view is of course from the Wells Fargo analyst Mike Mayo. And he doesn't expect banks to resume stock repurchases until second half of 2021. And in my portfolio, that affects Bank of America and Wells Fargo. The next news item is also related to the financial industry, where I have a lot of holdings in my portfolio, since it comes from the FDIC, which is short for Federal Deposit Insurance Corporations. So basically, they insure your deposit in the bank, in case you have an American bank. If you want to know more about FDIC, I will of course include a link in the description to the Wikipedia page so you can learn more about them. They were established in the 1933 after the Great Depression to restore faith in the banking system. So what they are seeing is that banks are setting aside a lot of capital since they expect a lot of the customers won't be able to meet their obligations, hence they are taking their losses already now. And they've also noted that bank capital and liquidity levels remain strong, asset quality metrics are stable, and the number of problem banks remains near historical low. So this is still a positive note for the banking sector. However, you should note this one down here. HSBC said in a memo it would resume cutting around 35,000 jobs over the medium term. So if you are employed there, then this is definitely not a good news to receive. The next news item is regarding Carnival Corporation. They are lower after their preliminary Q2 numbers. So currently they are burning through $650 million every single month. And at the end of the Q2 numbers, they had $7.6 billion in available liquidity. So that means that they have liquidity for a little less than 1 year. So unless they are capable of cutting down their cost more or getting more liquidity, they will go out of business if they are not starting to operate before that time. The next news item is really positive for me, since Abway, which is currently my biggest dividend payer, since it is the biggest holding that I currently have in my portfolio, has announced that they will pay a dividend which is in line with previous. So there is ex-dividend July 14th and it will be payable of August 14th. So really happy to see this news. So the last news item I want to cover is that 3M sales is declining by 20% in May. So just to highlight here, total sales dropped by 11% in healthcare, 12% in consumer, 17% in safety and industrial, and 30% in transportation and electronics. So of course this is not good news to receive for a company that you have in your portfolio, and it is no surprise that their stock was actually down due to this. I'm looking very much forward to see their Q2 results. I won't be able to have them in for next week's episode, since they will be announced the same day as I'm recording, and since I'm located in Denmark and they will be published in US, that will be too late for me, most likely. So that concludes yet another exciting week on the stock market. This time I really tried to squeeze in as much information as I possibly could, so everything from a speech by Jerome Powell to the little book of common sense investing, where I'm challenging my own view or my own way of investing. I will be happy to talk with people and engage, so please share your comments on that. Then I showed what I have invested in my portfolio. I shared some of the news which is relevant, and at the same time I had the opportunity to introduce FDIC, since I think a lot of my viewers are not familiar with them. So please take a look at that link if you want to learn more there. And until I see you next Sunday, remember to comment, like and subscribe. Bye!